Welcome to vTalkInsight, Allocator's Lens Daily for April 21st, 2026. The closure of the Strait of Hormuz is driving a sharp move in energy, yet equities and volatility still look calm. Today we connect how resilient earnings, higher for longer rates, tight credit, dollar strength, and a powerful real asset story all interact in this new regime. Equities are still the most optimistic part of the cross-asset picture, even as geopolitical risk and energy prices rise. U.S. benchmarks are hovering near record levels, supported by strong corporate results and upgraded earnings expectations, with this year's S&P 500 growth forecast now in the high teens after double-digit gains last year. AI remains the dominant narrative, powering a rebound in software and semiconductors, and large banks are lifting targets for leading platforms like Alphabet, Amazon, and chip names linked to cloud and data center demand. The flip side is that a striking share of index performance is coming from a small group of mega caps in the U.S. and large tech in emerging markets, such as major Asian semiconductor producers. That concentration, together with demanding valuations in parts of the AI and data center ecosystem, leaves the equity complex more exposed if growth or monetization timelines disappoint. Beneath the headline indices, sector rotation is increasingly shaped by the energy shock and conflict in the Gulf. Oil majors and defense contractors are outperforming as higher crude prices, rising U.S. and European defense budgets, and major rebuilding needs in the Middle East underpin multi-year revenue visibility. In contrast, airlines and travel names face rising fuel costs and the prospect of jet fuel shortages in Europe and Asia heading into peak season, with knock-on effects for tourism and consumption. Volatility remains surprisingly subdued, with the VIX still below 20 and term structures relatively flat, even as scenario analysis flags that oil above $100 could erode growth and a spike toward 120 to 140 could push the U.S. toward mild recession. Positioning has shifted from defensive underweights to more balanced or even pro-risk stances, so incremental buying power from short covering looks largely spent. With new IPOs lining up, evolving AI competition in chips and software, and emerging cyber risks highlighted by recent AI developments, equity markets look robust, but also finely tuned to incoming earnings guidance and any escalation in the energy shock. In rates, the dominant theme is a higher for longer backdrop complicated by the latest oil spike. Recent commentary from Federal Reserve officials, including some who had been more dovish, stresses concern about persistent inflation, and markets now see limited scope for near-term rate cuts, with policy expected to stay on hold at least through the summer. The U.S. 10-year yield has been trading in a relatively tight range around the mid-4% area, even slipping by roughly 10 basis points over the past week, a level that remains manageable for equities but still high enough to challenge traditional 60-40 allocations if it drifts toward 5%. Additional uncertainty comes from the Fed leadership transition, where investigations and court challenges, as well as a nominee signaling a tighter focus on inflation control and a smaller Fed footprint, raise questions about how responsive policy will be to future market stress. Europe's rate story looks different, but equally complex. The European Central Bank is not expected to resume hikes this year, yet bond yields are being pushed higher by the jump in energy prices and surprisingly strong inflation data, including a sharp upside surprise in German producer prices. Commentary highlights the risk that persistent oil and gas disruptions could leave Europe facing weaker growth and sticky inflation, especially in energy importing economies, reinforcing a stagflation narrative. Across global fixed income, there's growing focus on segmenting duration exposure. Short-dated and floating-rate instruments are seen as more insulated from renewed inflation surprises, while the 7 to 10-year part of the U.S. curve is viewed in some quarters as offering growth protection if the economy slows. At the same time, higher yields and a steeper structure make intermediate high-grade corporates and long municipal bonds stand out for their income potential, underscoring how dispersed the opportunity set has become within rates. Credit markets remain calm on the surface, with spreads tight and steady demand for yield, but the cushion against macro shocks is limited. Investment-grade corporates, particularly bank and financial issues, are viewed as relatively resilient given stable earnings and expanding loan books, with yields around 5% providing attractive carry compared with recent years. High-yield markets today are shorter in duration and higher in average quality than in past cycles, which some observers see as making selective exposure more appealing than parts of long-dated investment grade. In Europe, equity and credit risk premia are sitting near two-decade lows, implying a high degree of confidence that the current conflict and energy disruptions will not severely damage global growth. That leaves spreads vulnerable if the oil shock proves more persistent or if refinancing risks increase as rates stay elevated. Beneath public markets, private credit is emerging as a key stress point to monitor. Loans in many funds are trading below par as default concerns rise, while some retail-oriented vehicles face rising redemption requests at net asset value, testing withdrawal limits, and raising the probability of additional gating in coming quarters. The consensus view is that this stress is unlikely to trigger a systemic crisis, because leverage in these structures is relatively contained and credit risk is clearly allocated to investors rather than banks. Even so, losses for institutional allocators and tighter funding for small and mid-sized companies could be meaningful, especially with secondary private equity assets already marked at double-digit discounts to stated values. Family offices have already moved toward larger alternative allocations, and how they respond to this period of lower liquidity and higher dispersion in private markets will be an important signal for broader credit conditions. In foreign exchange, the near-term story is renewed strength in the U.S. dollar paired with slow-moving questions about its long-run dominance. Heightened tensions in the Middle East and the closure of key shipping lanes have triggered a broad dollar rally against major currencies, as investors seek liquid safe havens and U.S. rates remain relatively restrictive compared with peers like the European Central Bank. The dollar is also benefiting from its role alongside treasuries as a core holding during bouts of volatility, even as some asset allocators diversify incrementally into European and selected emerging market assets. Positioning in the dollar now looks stretched, and several analyses flag the potential for a sharper pullback if geopolitical risks ease and risk appetite improves, especially against currencies where rate differentials could narrow. At the structural level, the conversation around de-dollarization is getting louder, even though abrupt change still appears unlikely. Policymakers across regions are exploring alternative payment systems and issuance structures to reduce reliance on dollar infrastructure, and surveys suggest a gradual erosion of confidence in the dollar's future outperformance among clients in the Middle East, Asia, and Europe. Some Gulf states are reportedly considering turning to the Chinese yuan for backup financing if dollar liquidity tightens, even as long-standing pegs, such as in the United Arab Emirates, remain firmly anchored for now. The yuan has displayed pockets of resilience helped by China's trade surplus, while the Japanese yen remains under pressure due to low real rates and a delayed tightening path at the Bank of Japan, prompting talk of possible intervention. Views favoring a long dollar stance against currencies like the Australian dollar, yen, euro, and Korean won are grounded in these policy and growth divergences, but the energy shock in the path of the conflict will likely determine how long this configuration persists. Commodities are once again the hinge for the macro narrative, with the Strait of Hormuz at the center. Commercial traffic through the strait has largely ground to a halt amid U.S. and Iranian naval actions, leaving hundreds of vessels stranded and cutting flows from a route that normally carries around 1/5 of global oil supply. Crude benchmarks have jumped by 5 to 6%, with Brent trading in the mid-$90 area and U.S. crude approaching 90, while physical barrels for refiners are reportedly changing hands at much higher prices than screen quotes, especially in Asia after recent Saudi price increases. Even if limited traffic resumes, damage to more than 80 regional energy facilities, including liquefied natural gas terminals, means that output will not return to pre-war levels quickly. Some estimates point to a 2-year timeline for full recovery. That underpins scenarios in which the world faces a 2 to 3 million barrel per day shortfall into year-end, challenging expectations for a quick normalization in prices. The knock-on effects of this energy shock are already visible in the real economy, especially in Europe. Jet fuel inventories there are measured in just a few weeks, raising the risk of flight cancellations, route reductions, and broader travel disruptions at the height of the summer season. Combined with higher fertilizer and power costs, this feeds into concerns about food inflation and stagflation in energy importing regions. German growth forecasts have been revised lower as producer prices and energy costs surprise to the upside, while in scenario analysis oil above $100 pressures global growth, and a spike toward 120 to 140 could tip the U.S. toward a mild recession. even if fast-growing tech segments remain relatively resilient. Beyond hydrocarbons, the broader commodity complex has rallied strongly over the past 2 years, reflecting tight supply across energy and metals. Rare earths provide a clear example. China's dominance in mining and processing, together with export restrictions, has pushed up prices elsewhere and spurred U.S.-backed efforts to build a vertically integrated domestic supply chain, supported by government funding and recent corporate deals. Gold, meanwhile, still appears lightly held relative to the backdrop of geopolitical fragmentation and higher inflation volatility, suggesting scope for renewed interest in hard assets as part of a broader shift toward real assets and infrastructure in diversified portfolios. Stepping back across assets, the picture today is one of resilience on the screen and stress in the physical world. Equities are leaning on robust earnings and AI-driven growth, even as leadership narrows and sensitivity to energy prices and policy shocks increases. Rates remain in a holding pattern with a higher-for-longer bias, while credit spreads stay tight and private structures quietly digest liquidity pressure. The dollar is enjoying renewed safe haven demand, yet long-term questions about the global reserve architecture are gaining traction, and commodities sit at the center of the macro story as the Hormuz disruption, rare earth bottlenecks, and rebuilding needs lift the floor under inflation. For allocators, the key watch points are the trajectory of the Gulf conflict and oil supply, the next rounds of inflation data and central bank communication, and whether today's low equity volatility and narrow leadership can coexist with this more fractured macro backdrop. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.